My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate the solution for one of the exercises in the Spiceland textbook. That is exercise 1711, Berry Financial Services. Okay, so in Berry Financial Services, exercise 1711, all of the relevant data is listed here. It does continue on to the next page, where we are told about our cash contributions to the pension fund and the benefits that have been paid to retirees. And so what we need to do again is simply take all of this data and fit it into our worksheet. And so I have a blank worksheet already set up here. And normally where I like to start is with the beginning balances of the various accounts. The purpose of the worksheet is to help you organize all of the data. So just identify the data and where it goes in the spreadsheet, working from basically top to bottom of that worksheet. So we need to identify the beginning balances of the various accounts that are relevant. Normally I start with the trustee accounts. So for example, plan assets on January 1st, plan assets have a fair value of $2.4 million. And then the projected benefit obligation has a balance of $2.3 million. Notice here that the data also provides accumulated benefit obligation. That's computed on a slightly different basis than the projected benefit obligation. The difference between the two essentially is the PBO includes projections of future increases in salaries, where the accumulated benefit obligation does not. The FASB is very clear. US GAAP is very clear. Projected benefit obligation is what needs to be incorporated into the balance sheet disclosure. We can also disclose in the footnotes the accumulated benefit obligation, but the calculations cannot be based on that. So this accumulated benefit obligation of $2 million is basically a red herring for this particular problem. It's not going to be used anywhere in the analysis. And again, that's the benefit of using this worksheet. The worksheet doesn't say anything at all about accumulated benefit obligation, and so it's just simply not relevant. Okay, so we have plan assets of $2.4 million, projected benefit obligation of $2.3 million, and notice here that we also have some AOCI accounts, those accumulated other comprehensive income accounts. So there's prior service cost, has a balance of $325,000, and there is a net gain in AOCI that's being carried forward of $330,000. So we can take these beginning balances and put them into the worksheet as needed. So for example, our beginning balance of the plan assets is $2,400 or $2.4 million. I'm just going to ignore the zeros for now. And that's going to be, of course, a debit balance. And then the projected benefit obligation has a balance of $2.3 million. That's a credit balance. And we know that the difference between these two is the net balance on the employer's balance sheet. And so January 1, we are actually starting out with a $100 net debit balance. Plan assets exceed the PBO by $100,000. And so that's what we would show on our January 1st balance. We have a beginning balance in the prepaid pension asset account. It would be labeled prepaid pension asset since it does have a debit balance. The AOCI accounts, there is a net gain carry forward. Net gain carry forwards are always going to be credit balances. So a net gain has a credit balance. Net losses would have debit balances. And if there is any unamortized prior service cost, as in this particular problem, that will always be a debit balance. Those are expenses or costs that are being temporarily held in shareholders' equity and will be allocated periodically to the income statement. Okay, so those are our beginning balances. We don't have any knowledge about what our beginning cash balance is, so really don't care what that is. And that's the starting point. And we've already used a significant portion of the information that we need for this particular problem. All right, so now what we need to do is take a look at the worksheet, and typically the changes, the first set of changes that we would deal with are amortizations of the prior service cost, if it exists, and any amortization of gains and losses. The data in the problem tells us what the 2013 amortization is going to be. So for prior service cost, we are going to amortize $25,000. So prior service cost, I'm going to amortize $25,000, and since that is a debit balance account, remember that amortization means I want to reduce the balance of the account. So that means I'm going to place a $25,000 credit entry. I need a corresponding $25,000 debit entry then in the pension expense account. And this is exactly what's happening, right? We are amortizing some prior service costs, costs that have been temporarily classified in the balance sheet under AOCI, and we're going to put a little bit of that this year on the income statement by way of the annual pension expense account. Next item then is to deal with the amortization of any pre-existing gains or losses, and we're told here that the 2013 amortization of the gain carry forward is going to be $6,000. And so once again, amortization means reducing the balance. So in this case, since I have a credit balance account, I need to place a $6,000 debit entry to reduce that balance. And then there'll be a corresponding credit entry over here in the pension expense. And hopefully that makes sense. If I'm amortizing a gain to the income statement, that's going to reduce my expenses or help income. So a credit entry here reduces partially the annual pension expense that's required for the period. Okay, next up is going to be any actuarial gains and losses. There is no mention of any actuarial gains and losses, and so I just note that there's nothing happening here with respect to actuarial gains and losses. And then once we've done some of these issues that relate to prior periods, amortization of prior service costs, amortization of existing gains and losses, any actuarial gains and losses. Now we kind of move on to what's really happening this year, service cost, interest costs, and so on. So we need to identify what our service cost is for the period. And service cost for 2013, simply $310,000. Service costs represent an additional accumulation of benefits because our employees have worked for us for another year. And so that's going to be a net credit entry. The corresponding debit will be placed in the pension expense account. Next up is interest cost. The dollar amount of interest cost is computed as the discount rate multiplied by the beginning balance of the PBO, projected benefit obligation. That's again a partial reversal of the present value effects. So we either have to know what our interest cost is or know what our discount rate is. Discount rate here is 7%. And so I'm going to bring up my calculator, and my interest cost is simply going to be 7% times the beginning balance of the PBO, $2,300. And so I have $161,000 of interest cost to recognize this period. So I go back to my spreadsheet, and $161,000 credit entry. This is going to increase the balance of the PBO, and there will be a corresponding debit entry in the pension expense account. Next up would be the expected and actual rates of return. Again, this is where the FASB made some compromises. the expected rate of return is used as a credit to the pension expense, whereas the actual return that's generated is based on the actual increase in plan assets. And if there is a difference between the two, that will be squeezed into any sort of net gain or loss carry forward. So let's check and see what our data looks like here. Expected rate of return on plan assets was 10%. The actual rate of return was only 9%. So we can see the plan did not do quite as well as we had anticipated. So in any case, expected rate of return, 10%, is used to determine the credit entry to the pension expense. And that's pretty easy to do. 10% times the beginning balance of plan assets of $2.4 million. And so that's going to be a $240 credit entry to the pension expense account. Plan assets actually achieved a rate of return of 11%. And so we can figure out what plan assets actually increased by. 11% times the 2,400 is 264. I'm sorry. Did I get that right? Plan assets only went up by 9%. Sorry about that. So plan assets went up by 9% times the beginning balance of 2,400, and that's a $216,000 increase in plan assets. And so that will be the debit entry here to plan assets. Now I can't leave this line unbalanced. I need to force that line to balance, and in this particular case I need some additional debits. I have a $240,000 credit, $216,000 debit. I need an additional debit here to balance this thing out, and in this case that would be $24,000. That will force this line to balance. And so we can see here that this is effectively being treated as a loss. The plan assets did not generate as much of a return as expected, and so that is to our detriment. That's to the employer's detriment. And so it will be listed as a debit entry to this gain-loss carry-forward thing. The last two items that happened this year are contributions and benefits distributed. So cash contributions to the fund during the year amounted to $245,000. Benefits paid amounted to $270,000. And so we can deal with those directly in the worksheet. $245,000 credit entry to cash, and we contributed the cash to the plan assets. That's what the employers are doing, is funding this pension plan that they have. Benefits paid. Benefits are paid out of plan assets, and so we're going to reduce plan assets. That's a credit entry to the plan asset account. And we're also going to reduce the projected benefit obligation, which works out as a debit entry to the account. And so now I've completed everything for the year, and it's just a matter of completing the puzzle pieces, so to speak. So again, what I would normally do is deal with the plan assets in PBO. These are the plan administrator accounts. Beginning balance of $2,400 plus $216 plus $245 minus $270 works out to a $2,591 debit balance, ending balance for the plan assets. Do the same thing for the PBO. Beginning balance of $2,300 plus $310 plus $161 minus $270, and that works out to a $2,501 credit balance in the PBO. This, by the way, then leaves me with a $90 debit balance. The difference, the net difference between plan assets and PBO at the end of the year is a $90 debit balance. So we can see that the prepaid pension asset account, although is still a prepaid pension asset account, is not as large of a balance as we started out at the beginning of the year. And so now what I can do is focus on this summary journal entry, and I'm really using the summary journal entry as a check to make sure that I've done all the calculations correctly. So we take items B through I. Those are your journal entry elements, not these items up here. These are beginning balances. Items B through I make up the elements of a summary journal entry. So pension expense, I just add up all the debits and credits here, and I end up with a $250 debit entry to pension expense. I have a $245 credit entry to cash. I have 2 debits to the gain and loss carry forward account. That adds up to $30,000. And then I have 1 entry to the unamortized prior service cost account, and that is a $25,000 credit entry. And so now the last piece of the puzzle, so to speak, is to make sure that whatever dollar amount goes into this column right here, into this cell, forces the column to work and forces the journal entry to balance. So, and you can look at it either way. It's easy enough to see that if I start out with a $100 or $100,000 debit balance and I end up with a $90,000 debit balance, that would tell me I need a $10 credit entry. And then I can check across the row here to make sure that debits and credits are equal to each other. And so I've got $250 debit here, a $30,000 debit here. That's a total of $280. And then $245 plus 10 plus 25 is also $280. So my debits and credits balance. Ending cash balance, then, I don't know exactly what that is. My AOCI accounts start out with a $330,000 credit balance, had a net debit to the account for $30,000, and so that leaves me with a $300,000 credit balance. And then I end up with a $300,000 debit balance in unamortized prior service costs. Started out $325 debit, have a net $25 credit entry. That leaves a $300,000 debit balance in that account. And so now I've completed the worksheet, and I can then deal with the journal entry itself if the problem asks for it. And I can also deal with the financial statement disclosure and answer any questions regarding this plan. Importantly, we have a $250,000 expense, pension expense, that will show up on the income statement. And then my ending balances for the relevant pension account on the balance sheet, I'm going to have an asset of $90,000, and I'm going to have 2 AOCI accounts. So I'm going to scroll down here, and we can see that the journal entry is just exactly, it's a copy and paste from what's in this line. That's what this summary journal entry is all about. So I've got a $250,000 debit, a $30,000 debit to the gain carry forward, $245,000 credit to cash, a $10,000 credit entry to the prepaid pension asset account, and then a $25,000 credit entry to unamortized prior service costs. So that's the journal entry. And then the ending balances on the balance sheet are, again, just copy and paste from this last line in the worksheet. And so I would have a prepaid pension asset under the asset accounts on the balance sheet, $90,000. And then I would show my 2 AOCI accounts. One is unamortized prior service cost. That is a debit balance account, and so it appears as a negative to shareholders' equity. And then the gain carry forward is going to also have a $300,000 balance, but it is a positive. It's a credit balance account. So that's the solution for exercise 1711 in the Spiceland textbook.